In this presentation, you will learn about fire insurance. The development of fire insurance can be traced back to 1601 AD when the Poor Relief Act was passed in England. Letters called briefs were read from the church asking for collections from the public to help those who suffered losses from fire. 1666. There was a great fire in London, a historical disaster in which, within the span of 3 days, from 2nd to 5th September 1666, 80% of the city was destroyed. This incident sowed the seeds of fire insurances as we know it today. First, only buildings were insured, and the first fire office was established by a builder, Nicholas Bourbon, in 1680. In 1708, Charles Povey founded the Traders' Exchange for insuring movable goods, merchandise, and stocks against loss or damage, and this was the first to insure both the building and its contents. The term fire in a fire insurance is interpreted in the literal and popular sense. There is fire when something burns. In other words, fire means visible flames or actual ignition. Simmering or smoldering is not considered fire in fire insurance. Fire produces heat and light, but either of them alone is not fire. Lightning is not a fire, but if it ignites something, the damage may be due to fire. Under Section 2(6)(a) Insurance Act 1938, the fire insurance business is defined as follows. Fire insurance business means the business of effecting, otherwise than independently to some other class of business, contracts of insurance against loss by or incidental to fire or other occurrence customarily included among the risks insured against in fire insurance policies. Thus, fire insurance is a contract of indemnity to the insured for destruction of or damage to property caused by fire. The following are the items which can be burnt or damaged through fire: buildings, electrical installation in buildings, contents of buildings such as machinery, plant and equipments, accessories, etc., goods, raw materials, in process, semi-finished, finished, packaging material, etc., in factories, godowns, etc. Goods in the open, furniture, fixture and fittings, pipelines including contents located inside or outside the compound, etc. The owner of the mentioned properties can insure against fire damage through fire insurance policy, which provides financial protection for property against loss or damage by fire. Features of fire insurance. Offer and acceptance. It is a prerequisite to any contract. Similarly, the property will be insured under fire insurance policy after the offer is accepted by the insurance company. For example, a proposal submitted to the insurance company along with premium on 1st Jan of the year, but the insurance company accepted the proposal on 15th Jan. The risk is covered from 15th Jan, and any loss prior to this date will not be covered under fire insurance. Payment of premium. An owner must ensure that the premium is paid well in advance so that the risk can be covered. If the payment is made through check and it is dishonored, then the coverage of risk will not exist. It is as per Section 64 VB of Insurance Act 1938. Contract of indemnity. Fire insurance is a contract of indemnity, and the insurance company is liable only to the extent of actual loss suffered. If there is no loss, there is no liability even if there is fire. For example, if the property is insured for rupees 20 lakhs under fire insurance and it is damaged by fire to the extent of rupees 10 lakhs, then the insurance company will not pay more than rupees 10 lakhs. Utmost good faith. The property owner must disclose all the relevant information to the insurance company while insuring their property. The fire policy shall be voidable in the event of misrepresentation, misdescription, or non-disclosure of any material information. For example, the use of building must be disclosed, that is, whether the building is used for residential use or manufacturing use, as in both the cases the premium rate will vary. Insurable interest. The fire insurance will be valid only if the person who is insuring the property is the owner or having insurable interest in that property. Such interest must exist at the time when loss occurs. It is well known that insurable interest exists not only with the ownership but also as a tenant or bailee or financier. Banks can also have the insurable interest. For example, Mr. A is the owner of the building. He insured that building and later on sold the building to Mr. B, and the fire took place in the building. Mr. B will not get the compensation from the insurance company because he has not taken the insurance policy being an owner of the property. After selling to Mr. B, Mr. A has no insurable interest in the property. Contribution. If a person insured his property with two insurance companies, then in case of fire loss, both the insurance companies will pay the loss to the owner proportionately. For example, A property worth rupees 50 lakhs was insured with two insurance companies, A and B. In case of loss, both insurance companies will contribute equally. Period of fire insurance. The period of insurance is to be defined in the policy. Generally, the period of fire insurance will not exceed by 1 year. The period can be less than 1 year, but not more than 1 year, except for residential houses, which can be insured for the period exceeding 1 year also. Deliberate act. If a property is damaged or loss occurs due to fire because of deliberate act of the owner, then that damage or loss will not be covered under the policy. Claims. To get the compensation under fire insurance, the owner must inform the insurance company immediately so that the insurance company can take necessary steps to determine the loss. Procedure to insure the property under fire insurance. For insuring any property under the fire insurance policy, the following is the procedure. First, filling of proposal form. Second, inspection of the property. Third, payment of premium. And fourth, issue of cover note or policy document in lieu of acceptance of the proposal. Filling the proposal form. Description of property includes construction of external walls and roof, number of stories, occupation of each portion of the building, presence of hazardous goods, process of manufacture, the sums proposed for insurance, the period of insurance, history of previous losses, insurance history, whether previously other insurers had declined the risk, etc. Inspection of the property. In case of property of any business organization, whether manufacturing or other type of organization, a risk inspection report is submitted by the insurer's engineers. The engineers submit in their report the nature of risk involved in the factory or manufacturing unit. Payment of premium. Based on the proposal form and the inspection report of the engineers, the insurance company will submit the premium rates to the property owner, and if these rates are acceptable to him, then he should pay the amount to the insurance company. It is also a legal requirement under Section 64 VB of Insurance Act 1938 that the premium is paid in advance in full to the insurance company. Issue of cover note or policy document. On receipt of a completed proposal form and or inspection report, the cover note is issued, pending preparation of the policy document. The cover note is an unstamped document issued to provide evidence of cover till the time the policy is issued. The cover note provides insurance against specified perils on the usual terms and conditions of the company's policy. The printed policy form provides for a schedule in which the individual details of the contract are typed. The items are similar to those in the cover note, but with more detailed information. After issuing the policy document, it is likely that there may be some changes in the nature of property, or some insured may increase or decrease. In this case, these changes can be incorporated by way of endorsements, which are issued to record changes such as alteration in risk, increase or decrease of sum insured, etc. Procedure to settle the fire insurance claim. If there are any damage or loss arising due to fire, then the policyholder should immediately inform the insurance company in writing and with estimated amount of loss. Survey report. If the amount of loss is small, that is up to rupees 20,000, the insurance company may depute an officer to survey the loss and decide on the settlement of the loss on the basis of the claim form and the officer's report. However, in large losses, an independent surveyor, duly licensed by the government, is appointed to give a report on the loss. The survey report would generally deal with the following matters: cause of loss, extent of loss, underinsurance if any, details and value of salvage and how it has been disposed of or proposed to be disposed of, details of expenses, for example, fire brigade expense, compliance with policy conditions and warranties, details of other insurance policies on the same property, and the apportionment of the loss and expenses among co-insurers. Claim form. The policyholder will submit the claim form with the following information: name and address of the insured, date of loss, time and place from where the fire started, cause of fire, details of the property damaged such as description, etc., value at the time of fire, value of salvage, and the amount of loss. Details of other policies on the same property giving the name of the insurer, policy number, and sum insured. Fire brigade report details. FIR at the nearest police station regarding third-party liability, if any. Settlement of claim. On the basis of the claim form and the survey report, decision is taken about the settlement or otherwise of the loss. Standard Fire and Special Perils Policy. Fire and Special Perils Policy is an insurance contract that safeguards the insurer against unforeseen contingency caused by an accidental fire, lightning, explosion, destruction, or damage caused by aerial devices, man-made perils in the form of riots, etc. In India, under the fire insurance policy, in addition to fire, other perils are also included, and thus the policy is known as Standard Fire and Allied or Special Perils Policy. The perils specified in the fire policy are fire, as explained earlier, lightning, Any lightning due to cloudburst may damage the property, and the same will be covered under the fire policy. Explosion or implosion. Sudden change in the temperature in any plant or machinery or exposure to atmospheric pressure may result into loss, and the same will be covered under fire policy. Aircraft damage. Any damage to the property due to any droppings by aircraft or by itself will also be covered under the fire policy. Riot, strikes, and malicious damage. Any damage to the property due to public or strike by employees or malicious damage, which is intentional damage, by any person will be covered under this policy. Storm, cyclone, typhoon, tempest, hurricane, tornado, flood, and inundation. The property damage due to any of these storms and floods will also be covered under this policy. The meaning of these perils lies in different intensity of the storms. Flood not only means the leakage of water through rivers, but also accumulation of water due to heavy rains in the premises. Impact damage. Damage to the property due to impact by roll, rail, vehicle, or animal by direct contact, but not belonging to or owned by the insured or any occupier of the premises or their employees while acting in the course of their employment. Subsidence and landslide, including rock slide. Destruction or damage caused by subsidence of part of the site on which the property stands, or landslide or rock slide. Bursting and or overflowing of water tanks, apparatus, and pipes. If due to bursting or overflowing of water from the water tanks installed in the premises of the policyholder, any damage or loss to the property of the policyholder is caused, it will be covered under this policy. Missile testing operations. Any loss or damage due to missile testing by the government or otherwise will be covered under this policy. Leakage from automatic sprinkler installations. In most of the organizations, as a fire protection measure, automatic sprinkler system is installed. If due to non-usage of the sprinkler system or otherwise it starts leaking and damages the property, then it will be covered under the fire insurance policy. Bushfire. It means fire spread from the bushes, which is a smaller fire, but will not include forest fires. Fire insurance does not cover. In every claim, minimum deduction, say rupees 5,000 or rupees 10,000, will be made while settling the claim under this policy. It is to avoid small losses. Loss, destruction, or damage caused by war and kindred perils. Loss, destruction, or damage directly or indirectly caused to the insured property by nuclear peril. Loss, destruction, or damage caused to the insured property by pollution or contamination. Loss, destruction, or damage to any electrical and or electronic machine, apparatus, fixture or fitting, excluding fans and electrical wiring in dwellings, arising from or occasioned by overrunning, excessive pressure, short circuiting, arcing, self-heating or leakage of electricity from whatever cause, lightning included. Loss of earnings, loss by delay, loss of market, or other consequential or indirect loss or damage of any kind or disruption whatsoever. Earthquake. It is not covered under the fire policy, but by paying additional premium, earthquake can be covered. Special policies. The special policies of fire insurance are of different types based on the insurance hazards, insured risk, business type, and policy rules. Valued policy. The value of the prospectus to be insured. Here the insurer pays the total admitted value irrespective of the market value of the properties. The amount fixed may be greater or less than the actual market value of the property destroyed by fire at the time of loss. It is used for insuring paintings, sculptures, works of art, jewelry articles, etc. The valued policy is beneficial to the insured because he or she is relieved of proving the value of the property at the time of loss by searching for invoices and receipts. The valuation is revised at frequent intervals. The insurer will have to pay more than the actual loss if the market price of the property has gone down. Valuable policy is that policy where claim amount is to be determined at the market price of the damaged property. This policy represents the doctrine of indemnity. Floater policy. This policy is issued only for the stocks, not for the plant and machinery. Sometimes the stock is kept at various locations and it is very difficult to provide the value of stock at each location. Therefore, to cover the risks of stocks at various locations under one sum insured, an additional premium can be paid. For example, a person is having two go downs at Delhi and the value of stock is rupees 50 lakhs and he is not having the value at each location, then he can insure the stock under floating policy by paying an additional premium. Declaration policy. This type of policy is useful where there is frequent fluctuation in stocks or stock values and to avoid the underinsurance, insurance of lower value of the stock. Declaration policies can be granted subject to the following conditions. The minimum sum insured shall be rupees 1 crore. Monthly declarations based on the average of the highest value at risk on each day or highest value on any day of the month shall be submitted by the insured latest by the last day of the succeeding month. If declarations are not received within the specified period, the full sum insured under the policy shall be deemed to have been declared. Reduction in sum insured shall not be allowed under any circumstances. Refund of premium on adjustment based on the declarations or cancellations shall not exceed 50% of the total premium. The basis of value for declaration shall be the market value unless otherwise agreed to between insurer and insured. It is not permissible to issue declaration policy in respect of insurance required for a short period, stocks undergoing process, stocks at railway sidings. Floater declaration policy. It is the combination of the earlier mentioned policies, that is, stock lying at different locations and the value of stock fluctuating. Excess policy. The stock of a businessman may fluctuate from time to time, so the insured in this case can purchase two policies. One is the loss policy and the other is the excess policy. The minimum level of stock can be found out from the past experience and from the other portion of stock which exceeds the minimum limit. The actual value of the excess stock is declared every month. The average clause also applies to this policy. Specific policy. Specific sum is insured upon a specific property in case of a specified period. The whole of the action loss is payable provided but won't exceed the insured amount. The insured sum sets a limit up to which the loss can be made good. Average policy. Policy containing average clause is called an average policy. The amount of indemnity is referred to the value of the property insured. If the policyholder has taken policy for a lesser amount than the actual value of the property, the insured will be deemed to be his own insurer for the amount under insurance. The average clause is operative only. It is ineffective when the property is insured for the full value, as in that case the insured is protected to the extent of his total loss. Comprehensive policy. This policy undertakes full protection against risk of fire combined with burglary, riots, civil commotion, theft, lightning. This policy is beneficial to the insured and the insurer. The insurer can set higher premium and the assured is protected against losses due to specified perils. Sprinkler leakage policy. This policy ensures the destruction or damage to by water accidentally discharged or leaking from automatic sprinkler installation in the insured's premises. Add-on covers policy. An insured may like to cover his prospectus again to delete some of the exclusions. The additional cover is effected and included specific perils also, for example, earthquake. Add-on the cover is mid-term inclusion, but the annual premium has to be charged and not short period premium. No refund of premiums for the cancellation will be allowed unless the entire policy is cancelled. Additional terms and conditions. Reinstatement value. This is the fire policy with the reinstatement value clause attached to it. The clause provides that in the event of loss, the amount payable is the cost of reinstating property of the same kind or type by new property, that is, new for old. This basis of settlement differs from the basis under the fire policy, where the losses are settled on the basis of market value, that is, making deductions for depreciation, etc. Under reinstatement value policy, it is possible to cover the depreciated value of the building or machinery. The cost of replacement of the damaged property is ascertained by new property of the same kind. If due to technical improvements, the new machinery is better than the damaged machinery, example, output is increased with less consumption of power, the insured is obliged to bear a part of the cost of the new machinery to ensure that he does not derive any undue benefits. Thus, the principle of indemnity is still observed. The reinstatement value clause incorporates the following special provisions. Reinstatement must be carried out by the insured and completed within 12 months after the destruction or damage, or within such extended time as may be allowed by insurers, failing which the loss will be settled on the normal indemnity basis, that is, according to the fire policy. Until reinstatement is carried out, the liability under the policy remains on the normal indemnity basis, that is, market value basis. Pro rata average is applied by comparing the sum insured with the cost of reinstatement of the entire property insured as on date of reinstatement. The reinstatement basis of settlement will not apply. If the insured fails to intimate to the insurer within 6 months or any extended time his intention to replace the damaged property. If the insured is unable or unwilling to replace the damaged property, in such cases the loss will be settled on the normal basis of indemnity. The work of reinstatement may be carried out upon another site and in any manner required by the insured, provided the liability under the policy is not thereby increased. These insurances are granted to insureds whose bona fides are satisfactory and are generally issued only in respect of building, plant, and machinery in a comparatively new condition. These insurances are not granted on stocks. Local Authorities Clause. Reinstatement value policy may be extended to cover such additional cost of reinstatement of the destroyed or damaged property as may be incurred solely by reason of the necessity to comply with the building or other regulations under any Act of Parliament or bylaws of any municipal or local authority. Agreed Bank Clause. All policies in which a bank has a partial interest are to be made out in the name of the bank and owner or mortgagor and the agreed bank clause incorporated in the policy. The salient features of the clause are: the claim is payable to the bank whose receipt shall be a complete discharge and binding on all parties insured. Any notice under the policy is sufficient if given by or to the bank. Any settlement, compromise, etc., in relation to dispute, if made with the bank, shall be valid and binding on all parties insured. Any alteration or increase in risk does not invalidate the insurance, provided the bank notifies the same as soon as it comes to its knowledge and pays additional premium. Thank you for watching the presentation.